Okay, so this is Chapter 2 of Accounting 231, and in Chapter 2, what we're looking at is how we actually account for business transactions. So what we're going to see here is the way that we're actually going to go about recording this. In the past, in Chapter 1, we really just talked through some of these transactions. So we said, yes, we see an asset going up, yes, we see an asset going down, or a liability increasing, or an equity increasing or decreasing, whatever the case was. But we pretty much just left it at that. In Chapter 2, we're going to start really digging into what accounting is. And a major part of accounting comes from this idea of journal entries. And that's what we're really heading to in Chapter 2. And we'll do quite a few of them in this video. But what we really want to get into at first is just figuring out, how do we go from this transaction? Something just happened. We have a piece of paper. It might be a receipt, it might be a purchase order, whatever it is, but we've got something showing us that a transaction has occurred. How do we go from that all the way through to seeing this on the financial statements? So that's what we're going to try to deal with now. So the first thing that we're going to need is what we call a source document. So source documents are going to identify and describe transactions and events from the accounting system. These can be either hard copy, a printed paper receipt, or it could be an email, right? It could be an electronic format, a PDF, whatever the case. These provide information that is both objective and reliable. So we know this is actually what happened. And these are going to give us information about the transaction. What did we buy? How much of it did we buy, etc., and how much we paid for it. So examples are going to be things like receipts, checks, purchase orders, and the list goes on and on and on forever. But there's a bunch of different things you could see here. This could also include payroll records or bank statements, or, truly the list is quite extensive. The next thing that we want to do, so we're going to start with our source documents. Secondly, we want to analyze each transaction using the accounting equation. Okay? And if you remember back from Chapter 1, I told you there was one formula that if it was the only one you were going to learn all semester, it should be what the accounting equation is. And we said that the accounting equation told us that assets are equal to liabilities plus stockholders' equity, which I'm just going to abbreviate E as equity. So what this is going to allow us to do is to make sure that these transactions work, that we've got everything recorded properly. The next piece, which is where we're going to pick up in this chapter, is recording relevant transactions and events. So record relevant transactions and events in what we call a journal. This journal is where we're going to actually record these journal entries, which hopefully makes sense. The fourth thing that we're going to do is we're going to post to our general ledger, or to our ledger accounts. And finally, we will prepare and analyze the trial balance, which is going to be abbreviated as TB, and the financial statements, which is abbreviated as FS. So that tells us exactly what we're going to be trying to do. So with this, we first got to decide on a basic definition of what an account is. So what is an account? We're going to be seeing maybe even hundreds of accounts throughout the course of the semester. So it would behoove us to figure out right away, what does it mean for something to be an account? We saw just in Chapter 1, accounts receivable, accounts payable, cash, inventory. We saw all these things, and they're all accounts. So what does that mean? Well, what an account is an account is simply a record. of increases and decreases to a specific item. This could be an asset, a liability, an equity account, a revenue account, an expense account, any kind of item that we want to know what has happened to it over time. We're going to need an account to track that. Now, the general ledger, which we often just call the ledger, but the general ledger, so GL, is a record of all accounts used by a company and their balances. Now, that is what a general ledger is. The next thing we need to understand is what an unclassified balance sheet is. So, unclassified balance sheet, this just broadly groups accounts. So, broadly groups accounts as either asset, liability, or equity. Now, what you'll find is this is actually what we did in Chapter 1. We just said, hey, here's all of our assets, and we just lumped them all into one general area. What we'll see is this is not the actually appropriate way to be preparing a balance sheet. We did it in Chapter 1, and we may even continue to do it in Chapter 2 a little bit, but this is not proper because it does not provide the most useful information. Instead, what we'll end up preparing for most of the semester is what we call a classified balance sheet, which is where we actually differentiate between types of assets and types of liabilities, meaning we will separate those that are current assets from long-term assets and our current liabilities from our long-term liabilities. And so that's going to give us this classified balance sheet that we will see going forward in the semester. Now, as we talked in Chapter 1, we said that an asset was simply something that was owned or controlled by a company, and they have what we call expected future benefits. It doesn't matter how they're going to benefit us, but we expect there to be some kind of financial benefit in the future from possessing these items. So really quickly, this could be something like cash. So I'm just going to clear this page really quick, and we'll just jot down a few assets just so we have them. So examples. Please make sure you understand this is not all-inclusive. There are an infinite number of things that could be listed as an asset. We're just giving a few examples here. So things like cash, which should be pretty straightforward. You think, okay, well, cash is going to include any increases and decreases to the cash account. So what would that include? And you say, well, the cash, the actual cash that you have in that account. Very good. But is anything else included in there? And the answer might surprise you, and it's yes. What is considered cash in accounting is not just money, but also any funds that a bank accepts for deposit. So if you have coins, checks, money orders, checking accounts, savings accounts, all of these things can be included in this cash balance. So quite a bit can actually be called cash. Number 2, we have what we called accounts receivable. You will often see me abbreviate this as simply AR. This is just to speed us up a little bit so you don't have to wait on me to write this all day long. On the other side, when we talk about liabilities, we will have what is called accounts payable, which I will then abbreviate AP. But for now, we've got accounts receivable, and this arises from a credit sale. So the question may say, we made a sale on credit, or we made a sale on account. And we see either phrasing, that tells you that you have an accounts receivable. So that handles the second piece. The third asset that we want to talk about really quickly is what we call notes receivable. And I'm sure you can guess what abbreviation we'll be using for notes receivable, and it's going to be N/R, so notes receivable. This can also be called this can also be what we call a promissory note. What the difference is here is that this is typically a longer term agreement in writing. So you say, Well, that sounds good. And typically, this will have interest on it. So instead of someone just agreeing to pay me a balance in 30 days, maybe they're borrowing money over a course of 3 years, and I give them that loan, and there's 4% annual interest on it. So that note is going to be how I ensure that they actually are responsible to make those payments. Now, the next asset that we want to talk about is what we call prepaid accounts. So that's what your textbook refers to them as prepaid accounts. These can also be referred to as prepaid expenses. Now, do not get confused. 99 times out of 100, if you see the word expense, that account is an expense. It goes on the income statement and it will reduce net income and thereby reduce equity. But this is one of the few exceptions. In this case, this is not an expense. And you say, why? It's because of the word in front of it. Prepaid. You already paid for this, which means you actually have an asset. So you say, well, why on earth would you ever prepay something? So here's one example. Maybe if you pay your rent in advance, you get a small reduction in the total amount. So you decide you're going to pay your rent up front in January, but that will cover you from January all the way through December. So you've paid for 12 months of rent. At the end of January, you've only used 1 month of rent. That 1 month of rent will be expensed at the end of January. But you still have 11 months of rent that has not yet been used. Those 11 months will sit as a prepaid asset in the prepaid rent account, and each month you'll move 1 month's worth of rent to the expense and slowly reduce that asset. At the end of 12 months, your prepaid rent account will hit zero and it will be gone. And then your expense for rent will be the same amount as what you had paid. So it will work out eventually, but you do get these temporary issues with these prepaid accounts. You could also prepay things like insurance, or you could prepay for someone to do some work for you where you just go ahead and pay them now and then they come and do the work in 2 weeks. There's all kinds of different prepaid expenses you can see, but be careful. If you see the word prepaid, that tells you you're dealing with an asset, not an expense. So be very, very careful there. Don't let that trick you up. The next thing we want to talk about are supplies. And in the same vein as supplies, I want to look at something else that is equipment. And at the same time as that, I want to look at inventory. So, how are these three accounts different? Supplies. This is going to be things like staples, paper, ink that is used to run the business. So, that does not mean you cannot sell staples, paper, and ink, because if you are Office Depot and you sell staples, paper, and ink, then that could be in your inventory. So this is goods for sale to the public or to your customers. Whereas supplies are the things you use to keep your business running. So you're going to use some paper to print receipts. You're going to use some ink to do that. You might have to staple something. You might have to do various things. All those items are going to be supplies, even if your business is selling office supplies. Does that make sense? So you want to make sure you have that clear. If you're selling it, if it's on a shelf with a price tag waiting to be sold to a customer, you're talking about inventory. If it's something behind the counter that you're using to make sure your business runs, that is a supply. There can be some crossover in the actual items, but you just need to make sure you know what the purpose is, and that'll tell you if you're dealing with supplies or inventory. Now, the other one that we brought up just now was equipment. And equipment is typically long-term in nature, although you could have equipment that's only good for 6 months. But typically, we're talking long-term, which is more than 1 year, more than 12 months. and it will typically be subject to what we call depreciation. We'll deal with depreciation much later in the semester, but for right now, just be aware equipment is something that we're going to see, or we're going to track the value of that equipment over time, and we're going to slowly expense the price of that equipment through a process called depreciation. So this is once again an asset, and over time, the cost is treated as an expense through a process that is called depreciation. And that handles equipment for us. Next, you've got buildings. And finally, you have land. Now, with buildings and land, what you're going to see here is that there is a difference between a building account and a land account. So, to build a building, what do you have to have? You have to have some land. Because if you don't have land, you have nowhere to put the building. So they are related. I hope you see that you cannot have a building and not have somewhere to put it. So you have to have both. The distinction here is that the building is subject to depreciation. Very similar to how equipment is subject to depreciation, but land is not subject to depreciation. And so what that's going to mean is you're going to have to very carefully assign the cost that is for the land to the land account, because it will never go down. It will never turn into an expense. It will never be devalued, versus the costs that are assigned to the building. And we'll dig into some examples with this later in the semester. But for now, just be aware, when we get there, you're going to have to be very careful that you don't misallocate between the building account and the land account, because it can create some pretty serious misstatements if you do that. So that wraps us up with the examples that we wanted to go through on assets. Next, we're going to look at different liability accounts. For liability accounts, we're going to see things like accounts payable, notes payable, unearned revenue. So I'm just going to clear this real quick and we'll hit those right now. So examples of liabilities. We have accounts payable, which is where we owe somebody money. So maybe SFA works out a deal with Staples right down the street, where we say, we will buy 1,000 reams of paper from you this month, and instead of paying you today, I'll just pay you on the 1st of the next month. Staples agrees to that. So we go down there on whatever date today is. We purchase those 1,000 reams of paper. They deliver them for us. We're good to go. And no cash changes hands at that time. Instead, what we show is that an asset went up, paper, or supplies, however we care to account for that, and a liability went up, which is the accounts payable. So that will go up. This will be often phrased as us buying something either on credit or on account. So if you see either one of those terms, make sure you understand that that is an accounts payable. Just like we had notes receivable, we also have notes payable. It's the same deal. Instead of this deal that we worked out with Staples, it's a loan from a bank, for example, that does have interest attached. It is in writing. It has all these characteristics that make it a note. The next one that we want to talk about is unearned revenue. Now, where does your eye naturally go? Typically, you will see the word revenue and you will jump and you will say, oh great, it's a revenue account. It goes on the income statement. I'm done. Man, that was so easy. Please do not make that mistake. This is a liability. And you say, well, how on earth is a revenue a liability? And I would show you to the first word here, unearned revenue. Because you have not earned it, it would be a violation of the revenue recognition principle that we talked about in Chapter 1 to recognize revenue when it has not yet been earned. So, here's the example. June 18th, customer pays us, we are paid to construct a fence. Okay. So our customer comes to our office today, we're a construction company, and says, I just bought a new house, I've got a little dog, I need a fence around my yard to make sure that the dog doesn't escape. So I say, fantastic, you can either pay today, you can pay when we finish, whatever you want to do is fine with us. And he says, well, I'm already here, I might as well just pay today. Boom, he hands us some cash. So we received cash, but we have not done anything. And because we've not yet built that fence, we do not have revenue. Because what happens if between June 18th, and say we're contracted to go out there on June the 25th. So we are supposed to go on June the 25th to build the fence. That's what we agreed to. On June the 25th, we're going to go out there and build that fence. But on June the 22nd, there is a fire in the house, and the house burns all the way to the ground. There is no more house. Do they still need a fence? Well, of course not. There's no more house. So they don't need a fence, and because they don't need a fence, we're not going to build the fence. Because we've not done anything, and because we're not able to perform the service, then we must return the money. If, however, we come out there on June the 25th, and we do build the fence, then on June the 25th, we can recognize revenue. But we can only recognize the revenue once the job is done. Okay. Now, it may depend on the contract that the person signed, right? If they said, this is non-refundable under any circumstance, blah, 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 there may be a route where you could keep the money. But generally speaking, that's not going to be the case. And if for some reason we are unable to perform the task that was set for us, then we must return that money because we have not provided the service. Until it has been earned, it is unearned. And when it is unearned, it is a liability. So do make sure you understand that until you have actually earned it, it does not matter if you received the cash. We do not recognize revenue when cash is received. That is true under cash basis accounting, but that is not the focus of this course, nor is it allowed under generally accepted accounting principles. Instead, we recognize revenue when earned. Okay? So do make sure you have that. So don't get hooked on the word revenue. Get hooked on the word unearned, and that will tell you it is a liability. Now, the next thing that we need to talk about here is what we call accrued liabilities. I think the easiest way to understand what an accrued liability is to think about your job. So assume you have a job and you get paid every 2 weeks. You work Monday through Friday every week. So you come in on Monday, you just gotten paid the last Friday, so you're good to go. You have now worked 1 day out of the 10-day period that you're paid for. Well, technically, you have earned the wages from that 1 day. You provided 1 day's worth of work. You should technically receive 1 day's worth of pay immediately. You don't. You get paid every 2 weeks. Because you get paid every 2 weeks, your employer is going to accrue for your wages every day until the end of that second week, when they will cut you a check for 2 weeks worth of work. At that time, the accrued liability will go to zero and they will pay out the cash. So that is how that is going to work. So we'll get into that as we actually deal with some of the journal entries that we'll see in a little bit, but hopefully that makes some sense. Now, the next thing we want to talk about, since we have just talked about assets and liabilities, it would then make sense to talk about equity. So when we talk about equity, what we want to think about is this idea here. So we're dealing with equity. And we're going to say that equity is equal to common stock plus revenues minus expenses minus dividends. Now, quick question for you. Are dividends an expense? Hopefully, you just said no. And we discussed this in the Chapter 1 video, but we'll discuss it again here briefly. Dividends are not an expense because there's no revenue to match with them. So instead, they are treated as a direct reduction of equity. If you can't remember that, remember this formula. If dividends were an expense, why on earth would we list dividends and expenses separately? There would be no reason to. But because dividends are not an expense, we do see those get listed as two separate items. So however it makes sense to you is fine, but you do need to understand dividends are not an expense. Not now, not never. Now, think, what does that mean? What goes on the income statement? What goes on the income statement is revenues and expenses, at least for now in this course. We will see later in the semester other items trickling in. But for this moment, revenues and expenses go on the income statement. If dividends are not a revenue and they are not an expense, then they do not go on the income statement. Instead, you will see them in two places. You will see them on the statement of retained earnings, where you see the reduction in equity happen, and you will see them on the statement of cash flows, assuming they are a cash dividend. There are other ways to do dividends. You can do a stock-based dividend, and in that case, you would not see it there. So you might not see it in that case, but you will definitely see it in the statement of retained earnings. Okay, so that breaks through on that. The next thing we want to look at is our equity accounts in a little bit more detail. So we're going to see things like owner investments. So owner investments are going to be where we put in cash or equipment, for example, and we give the owner some stock in the company. This will increase equity. The next piece we see are owner distributions. This tells us that this is when a corporation distributes assets to the owner, and it increases both the company's assets and equity. I'm sorry, I misspoke. It decreases both the company's assets and equity. The reason it decreases them, of course, is because we are paying out cash or some other asset to the owner of the business, and we are seeing the equity go down because as dividends go up, equity will decline. And that's exactly what we see here. So if we just plugged in some fictional numbers here and we used 100 for common stock, 50 for revenue, 75 for expenses, and 25 for dividends, then we will see that equity is equal to 50. If you keep everything the same, so 100 plus 50 minus 75 minus 50, then your equity will only be 25. So as this dividend number increases, your equity number will decrease. And so that's what we're showing right here. I'm sorry for the misspeak, the incorrect verbiage a second ago. But now we will move on and we will see that we have revenue accounts. Revenue accounts will in fact increase equity. And so what these revenue accounts will do is they will eventually flow through to the income statement and increase net income. On the other side of this, of course, we have expense accounts, and expense accounts are all going to always decrease equity as they increase. So as we pay our employees more, as rent costs more, as advertising costs more, we will see our equity decline because our expenses in total will increase, which will reduce our net income and could eventually lead us to a net loss. So that handles the equity section. Now, briefly earlier, we discussed what a classified balance sheet was. So I'm just going to draw you one out really quickly. And what we're going to see here is kind of the general form that these will take. So I'll say ABC Company. And I'm going to leave out some of the other stuff because we haven't really talked about preparing a formal one yet. We'll address the full title later in the semester. But for now, I'm just going to show you the general form. So we've got assets, then we will see current assets, and we'll list all those current assets, whatever they are, right here. Then we will have long-term assets. This could also say non-current assets. We'll list all of those right here. This will come down. Then we will see total current assets, total long-term assets, and finally total assets. And this will make up the left side of our balance sheet. We will then see liabilities. We will see current liabilities. We will list those. We will have total current liabilities. Then we'll have long-term liabilities. We'll list those. We'll have total long-term liabilities. Then we'll have total liabilities. Then this will say equity. We will list all of our equity accounts. This will then say total equity. That will give me a number. And then we will have total liabilities and equity. And we should see that these two numbers will end up being the same. So then my total assets will equal my total liabilities and equity. So hopefully you see just the general format that this balance sheet will take when we prepare a classified balance sheet. This is obviously much more detailed than what we saw in Chapter 1, where we just said assets and listed them, liabilities and listed them. You'll notice the equity section, we do not have a current equity section and a long-term equity section. And that's because it just wouldn't make sense. When we're dealing with equity, the equity isn't current or long-term, it just is. It just is in the equity portion because it's not necessarily going to get used in the next 12 months or in more than 12 months, so we don't make any kind of distinction there. But for our current assets, we look at it and we say which assets are most likely to be used within the next 12 months and which assets do we expect to persist longer than 12 months. And on the other side, we say which liabilities are due and payable within the next 12 months and which are not due and payable within the next 12 months. So, we have covered quite a bit of ground in this video. So now we're going to get into what is called double entry accounting. So I'm just going to briefly show you what this is, and then we're going to just jump straight into the homework, because this part doesn't make a whole lot of sense unless you really start to dig into it. So I want to make sure we have the time to do that. So I'm going to just draw up here really quickly, assets equals liabilities plus stockholders' equity. This is our accounting equation. Now, here's what is going to be the bulk of the rest of the semester. Is if you can understand these T accounts and you can understand how these work, the rest of the semester will make much more sense and be much more simple. If these throw you for a loop, then you really need to slow down and make sure you get a good understanding here, because once we move on from Chapter 2, it does not slow down. So this is your chance to make sure you're caught up, because once we hit Chapter 3 with adjusting entries, closing entries, and all sorts of stuff, everything starts moving in every direction. This is the opportunity to get a really solid foundation. So let's make sure we make the most of that opportunity. So what this T account is going to do is it's going to show us that on the left side, we will put anything that we debit. Okay? We haven't used that term up until this point, but just jot it down. We'll talk about it in a moment. On the right side, we will write down anything that we credit. This will be true for every T account, regardless if the account is an asset or a liability. These T accounts work so well because it lets you visually see exactly where everything is going. So, the next thing we need to talk about is what is called a normal balance. So, a normal balance says this is what makes that particular account balance increase. If it is normal, then doing that to that account will make the balance increase. So the question is, do assets have a normal debit balance or a normal credit balance? The answer is that assets will increase with a debit and decrease with a credit. Liabilities, which are the opposite of assets, increase with a credit and decrease with a debit. And then stockholders' equity will increase when credited and decrease when debited. So if you just look at the equation and you draw a line right here, everything to the left of that line, which is your assets, increase on the left side of the T account. And everything to the right of that line increases on the right side of the T account. Now, equity gets pretty tricky, so we'll dig into specific accounts in equity. But the rest of it, hopefully, you'll see pretty quickly how this is going to work. But what we're going to do now is just look at the example of cash. So we talked earlier about cash, and we said there's all this stuff included in cash that we might not have expected, but it's still cash. So if you receive cash, would you debit the cash account for the company? If the company receives cash, does the company debit the cash account or do they credit the cash account? The company will debit the cash account because cash is an asset and assets increase with a debit. So let's think. More than likely in your wallet, you have a card, and that card is called a debit card. And this debit card says that every time you swipe that card, you either receive cash in your account or spend cash from your account. So just think through it for a second and figure out, when you swipe that debit card, does your cash balance increase or decrease? Well, unless you're just extremely lucky, when you swipe that debit card, the cash balance in your account should go down. And you say, well, what's going on? You just told me that a debit to cash makes cash go up. But now you're saying a debit to cash reduces my cash balance. Which one is it? They can't both be true. And actually, both statements are perfectly accurate. Because here's what is happening. On that debit card, there is another name other than your name, and that is the name of the bank. When you make a deposit to a bank, it becomes a liability for the bank, because if you come asking for that money, the bank has to give it to you. So as the bank has your cash, they're increasing a liability. But as you spend that money out of your account, they no longer owe you that money. So what's happening is they are debiting your account by debiting the liability that is created by your checking account sitting there. So hopefully this makes some sense. It's a pretty crazy example, I know, but hopefully with that you can kind of see what's happening and how it's so important to understand which direction we're looking at a transaction from. If you're looking at it from the side of company A or company B, from the side of the individual, whoever you're looking at it from, it completely changes the debits and the credits. So let's move on. But this is our basic understanding of these T accounts. So what I'm going to do is I'm just going to move into the homework, and as we get to examples with journal entries, we'll walk through them quite slowly, but we'll make sure that we're always coming back to this kind of idea, and we'll identify what type of account is this, where does it go, what's the normal balance. And this is something I really recommend you take the time to do in Chapter 2, because as we move on, these classifications are going to need to be pretty quick. You're going to need to be able to look at something and tell me, is that an asset, a liability? Is it an equity? What's the normal balance? And even what financial statement that account goes on rapidly. You're not going to have time to sit there and think about it for 10 minutes. You're going to have to know. So what that means is you can't memorize, because there's an infinite list of accounts that I could put on an exam, on a homework question. So what you're going to have to figure out is being able to identify what type they are, and then because of what type they are, you know everything else about that account. So hopefully we'll be able to develop that intuition as we work through this homework together. So here in Chapter 2, the very first question asks us to just classify each account as either an asset, a liability, or an equity. That's it. I will say if you have an exam with me in class, be very careful and always read the directions. Because if I give you a question like this, but I also include things like revenues, expenses, etc., then I may have you use a slightly different abbreviation than what the homework does. And you could end up missing a point or two because you used the wrong abbreviation and therefore missed the question. So always make sure to read very, very carefully. I don't do that intentionally, but sometimes there will be a discrepancy between how I ask you to write something on a test and how the homework system does it. So just make sure you know that you need to read through those instructions and ask me if you have questions about the instructions. I'm always happy to answer those types of questions. So in this case, we see an accounts receivable. So we say, well, what's the key word here? And it is that this is a receivable. Because it is a receivable, that tells us that we do have an asset. So even though this is not part of the question, I'm going to go ahead and say that we need to do this. So what I'm going to do is I'm going to just draw out a column here. This I'm going to label NB. It's just normal balance. Okay. So we're just going to look at each one of these and we'll see, does this account have a normal balance that is a debit or a credit? All right, you got a 50-50 shot. So hopefully you're working through this with me and you're getting a little bit ahead of me. And so you can kind of use this to check your understanding. Beyond that, I also want to ask you which financial statement each of these accounts appears on. So there is a question in your homework that does this, but I don't believe you can do this too much. So we're going to do this here as well. So what we're going to see is that the accounts receivable account is an asset. And I'm going to say if it is a debit, I'm going to say D. If it is a credit, I'm going to say C. And if it is the balance sheet, I will say BS, or the income statement, I will say IS. And if it is dividends, or the statement of retained earnings, I will just put RE. Okay. So that's how we'll handle these classifications. So accounts receivable is an asset, and assets have a normal balance of a debit, and assets go on the balance sheet. Okay, so we'll just zoom in a little bit to make this a little bit easier to see. Notes receivable. Once again, this is a receivable, so this is still an asset. Assets have a debit balance and go on the balance sheet. Wages payable. You see that keyword payable and you jump and you say that is a liability, and you are in fact correct. That is a liability. Liabilities have a credit normal balance, and liabilities go on the balance sheet. Next, you have equipment. Equipment is an asset, and assets have a debit normal balance, and they go on the balance sheet. Prepaid rent, that is an asset. Assets have a debit normal balance, and they go on the balance sheet. Dividends, that is part of equity, but because dividends reduce equity, they actually have a debit normal balance, and they go on the statement of retained earnings. Now, you may look back, and if you do, right here, you say, but when we talked about stockholders' equity, you just said that an equity increases with a credit, and that is true. But I also said equity is a kind of tricky section because there's a bunch of stuff in the middle. So what you've got to think is equity itself increasing or decreasing? Because you're paying stuff out of equity to the owners, then that is actually a reduction in equity. And when you reduce equity, you do it with a debit. Now, salaries payable. Once again, you hook on the keyword payable, and you say that is a credit, and that will go on the balance sheet. Next, you've got common stock. Common stock is an equity account. Equity accounts increase with a credit and go on the balance sheet. And prepaid insurance. So you hook on the fact that this is prepaid, which tells you it is an asset, which means it has a normal balance of a debit and goes on the balance sheet. And that wraps up this question for us. So we accomplished a whole lot in this question, I think. We hopefully have a pretty good understanding of how all of this works now, and we can move on to question number 2. So in question number 2, we're then going to identify the normal balance. So you'll see we're doing this quite a bit in this homework assignment to make sure we really understand how these questions are working. I'm once again going to ask you to identify the classification. And you don't have to do this on the homework because it's not graded this way. But just for the additional practice, I will ask you for the classification, which means asset, liability, equity, etc. So classification and the financial statement. So we're going to get quite a bit of practice doing this, and we'll use the same abbreviations we saw before. So in this case, you have office supplies. Office supplies are an asset. They go on the balance sheet, and assets have a normal balance of a debit. Next, we see a building. A building is an asset, specifically a long-term asset that goes on the balance sheet with a debit normal balance. Dividends are a debit normal balance. The classification here, I'm almost certain they just called it equity on the last question, but normally we will refer to dividends just as dividends, just to avoid any confusion. But it appears in this homework they're referring to it as just an equity account. That's totally fine. It is true. It just can lead to confusion down the road. But for now, we'll leave it as just an equity account. And the financial statement is the statement of retained earnings. Next, we see note receivable. Notes receivable is an asset that goes on the balance sheet and has a debit normal balance because it is an asset, so it will increase with a debit. Next, we see advertising expense. Advertising expense, I'm going to refer to as an expense, so just EXP. You could call this an equity account if you wanted to, unless I gave you the option of equity or expense. If there's the option to call it an expense, definitely call it an expense. You want to name it most closely. If that option is not there, it is part of equity. You could get away with that. Just be very careful. Next, which financial statement does that go on? That is on the income statement. Now you see delivery expense, rent expense, and legal expense. So I'm just going to draw an arrow straight down. All 4 of those accounts, including the advertising expense, are expenses with debit normal balances that go on the income statement. And the last one here is interest payable. Because it's a payable, we have not actually turned loose of any cash yet. That makes it a liability because we will have to pay it in the future, and liabilities go on the balance sheet. Because it is a liability, then the normal balance is a credit. So hopefully this is making some sense to you. Now, in this question, we're told for each transaction, we need to analyze the transaction using the accounting equation, record the transaction in journal entry form, and post the entry using T accounts to represent ledger accounts. Use the following partial chart of accounts, blah, blah, blah. All right, and they give it to us. So they say, on May the 15th, Deshaun Taylor opens a landscaping company called Elegant Lawns by investing $87,000 in cash, along with equipment having a value of $47,000 for common stock. So what we're going to see is that our assets, in this case, are 87 plus 47, which gives me a total of $134,000 in assets. And because we gave up equity equal to that, then the equity in the company increases by 134 as well. In the next question, it tells us here, on May the 21st, they purchased office supplies on credit for $620. Because this is on credit, no cash changed hands. So supplies went up by $620, and accounts payable went up by $620. So you see a liability go up by $620, and you see the associated asset also going up by $620. Now, the next thing that we want to look at is the third example. So the third example tells us that Elegant Lawns received $9,500 in cash for performing landscaping services. So because we performed this, It means we have earned it. Because we have earned it, it is a revenue. And because it is a revenue, equity has increased by $9,500. On the flip side of that, we did receive cash. And so because we received the cash, we do have an asset, namely cash increasing by that amount. Had we not received cash, we still would have had an asset increasing by that amount, but that asset would have been accounts receivable and not cash. So do make sure you understand the distinction there. Now, on May the 30th, Elegant Lawns receives $2,700 in cash in advance of providing landscaping services. So, we received the cash. Did an asset increase? Yes. What asset? Cash. So cash is increased by $2,700. But because we have not yet earned the money, because we have not provided those landscaping services, we do not have revenue. Instead, we have a liability. Do you remember what that liability is called? That liability is called unearned revenue. And that's exactly what we're going to see when we actually record this journal entry. But for now, you just need to realize we have a liability that has just increased by $2,700. And so that takes us through the very first part of this question. Now, the second part of this question asks us to do the journal entries. So the very first thing I'm going to do before we even do the journal entry is just go over proper journal entry format. So, as you see, they'll normally number the journal entry to the left and call it like journal entry 1. You'll normally have a date, in this case, May 15th. You will then list on the margin all of your debits. So debit 1, debit 2, debit 3. However many debits you're going to have will all be listed initially at the top of the journal entry and all the way to the margin, so all the way to the left-hand side. Your credits will then be indented and they will go down in order. So then you will have credit 1, credit 2, and on. Now, please do know the number of debits and credits does not have to equal. I can debit 3 accounts and only credit 1 account. I can debit 2 accounts and credit 14 accounts. That does not matter. The number of debits and credits does not have to equal. But your total debits must always equal total credits. If you ever turn in one where debits do not equal credits, it is wrong. Because the total dollar amount to debits must always equal the total dollar amount of credits. So, do keep that in mind. So what you will see here in this first one, it tells us. So we'll just walk through how we record this first journal entry. We'll do it quite slowly since we're just brand new to seeing journal entries. So it tells us once again, on May the 15th, Deshaun Tyler opens a landscaping company called Elegant Lawns by investing $87,000 in cash. So stop. What just happened? The business received cash. When the business received cash, the question is, did cash increase or decrease? Well, cash just increased. The next question you need to ask yourself is this: what type of account is cash? Cash is an asset. And if an asset increases, then you debit the asset. So, the very first thing that you see is a debit to cash for $87,000. And that portion of this entry is done. Now we keep reading. He also invested equipment having a $47,000 value in exchange for common stock. So, the next thing we see, what happened to equipment in the company? Did the company receive equipment? Yes. So, is equipment increasing? Yes. And what type of account is equipment? Is it an asset, a liability, or an equity account? Well, equipment, similarly to cash, is an asset. And if an asset is increasing, you debit the asset. So you see here that you debit equipment for the $47,000. Now, what you've then got to do is figure out how to handle the common stock. Well, there's two routes here. And in this case, there's really only the one. Typically, you can either back into it or add everything up and subtract. In this case, there's really only one way to go. You know that because of the accounting equation, we're told that assets must equal liabilities plus equity. If assets just increased by $134,000, that means there has to be a change upwards of $134,000 in liabilities and equity. Somehow, it can be 50% liabilities, 50% equity, 100% equity, no liabilities, 100% liabilities, no equity. It can be any type of change, but you know there's got to be something, right? Or the asset change has to zero out, but something is not done yet because this equation does not balance. So the next thing you got to see is we got common stock. So if we gave out common stock, you then need to ask, well, what type of account is common stock? Because common stock is increasing, and that is an equity. Because it is an equity that is increasing, we must credit the account. So you see then that the full balance is the 134 as an equity increase, which tells you no increase to liabilities, and that explains why we have this credit of 134 to common stock. So you've got cash 87 as a debit, equipment as a debit for 47, and a credit to common stock for $134,000. And that wraps up our very first journal entry. So hopefully that one makes some sense, and we'll move through the rest of these slightly quicker, but we'll still go through the same process. So in the next question, we're told that we purchase office supplies on credit for $620. So what type of account is office supplies? And I'm just going to write supplies because it's shorter, but do make sure you use the proper account, office supplies, in your journal entry. So supplies have increased, and they are an asset, and when an asset increases, you debit the account. So you debit office supplies for $620. Next, you're going to come in and you're going to look at accounts payable. So with accounts payable, you see that accounts payable is a liability. And if a liability is increasing, then you must credit the liability. And that's exactly what we see here. So if you just flip back to the initial T accounts that we looked at, we said a liability, if it is increasing right here. So if you're dealing with a liability that is increasing, then you credit the liability. And if you're dealing with an asset that is increasing, then you debit the asset. So this is exactly what we're doing. Just now we're doing it with numbers. So the next question asks us, what do we record if we have the situation where we receive $9,500 for performing landscaping services? So we received cash. So cash is increasing. Cash is an asset. And if an asset is increasing, then you debit the asset. Next we see that we have landscaping revenue, which is a revenue account. And if a revenue is increasing, then you credit the revenue. And you say, whoa, you didn't show me this earlier. Earlier, you just left it as equity. And you're absolutely right, I did. What you can do is you can actually break out that equity T account into many different smaller T accounts for things like revenue, expenses, dividends, common stock, treasury stock, additional paid in capital. All of these items will eventually fall into that equity bucket. So instead of showing you all of those T accounts, I just showed you the main one for equity. But when you think, you need to think, well, what happens when I have extra revenue? Is that good for the organization? And the answer is yes. Additional revenue is a good thing, and it will increase net income, and that increase to net income will increase equity. And so you can see that. What I do want you to be careful about, though, is I don't want you getting in the habit of thinking A debit is a good thing, a credit is a bad thing. Because let's think about the stuff that gets debited. If you receive an asset, or an asset is increasing, that is a debit. But what else is a debit? Well, a reduction in equity is a debit. So expenses get debited. That is not a good thing. What about on the credit side? Well, revenue receives a credit. We like that. We like revenue. What else receives a credit? A reduction in an asset or an increase in a liability, both of which we don't like too much. So the point here is, don't get in the mindset of debits are good, credits are bad, or debits are bad and credits are good. It really just depends. You've really got to know what account you're looking at to know how this is going to get handled. So now we'll look at the last piece here. And in this last piece, what we're seeing is that we received $2,700 in advance. So did we receive cash? Yes, right? We received cash. So we have cash. Cash is an asset. That asset is increasing, so we debit the cash account. But this was in advance of providing services. So what we also have is the account unearned landscaping revenue. Now, is this a revenue? No, it is not. This is a liability account. Because it is a liability that is increasing, you will then credit the account. And you say, well, in this case, it wouldn't have mattered. Because if it was a liability, it gets a credit because it's increasing. If it were a revenue, it would still increase with a credit. It would all work. Halfway. You're right. You could get the journal entry right if you didn't know the difference. But if I asked you to prepare financial statements, very quickly you would be having trouble. Because unearned landscaping revenue is a liability. And liabilities go on the balance sheet. But a revenue account is revenue. And revenues go on the income statement. So you can see that you would very quickly be assigning this to the wrong financial statement if you were unable to identify what type of account this is properly. So make sure you're able to do so. Okay, I'll move on to the last piece. And so I'm not going to walk through this piece too much. I'm just going to show you maybe on the first one. So on the first one, we see Deshaun Tyler opens a landscaping company, investing $87,000 in cash. So I'll come down here. I'll see on May 15th in my cash T account an increase of $87,000. Once again, debits on the left, credits on the right. So this will be the side for my debits. This will be the side for my credits. Now, what else happened on that date? Well, also on May the 15th, we invested $47,000 in equipment. So I will now find my equipment T account. I will label the date as May 15th, input my $47,000. And finally, I will come down to my common stock account, locate the date May 15th in this drop-down box, and put the total of $134,000. And you'll do this after you complete your journal entries, so you can really just pull the information straight out of your journal entries and move it down into these T accounts, and then you'll be done with question number 3. Now, question number 4 does exactly what we did on questions 1 and 2, but here they require you to do it. So hopefully by now you're going to be a pro at it because we've already done this twice. So we'll walk through this one quite quickly. But if you do have questions on it or on anything else in this assignment, please do contact me immediately and I will do my best to get back with you and help you make sense of anything I can. So in this case, we see for each of the following, we want to identify the account as an asset, liability, equity, revenue, or expense, identify the normal balance of the account, debit or credit, and identify the kind of entry that would increase the account balance. All right. So for the first question here, we see fees earned. Fees earned is a revenue. It's just another word for revenue. And if it is a revenue, we know that revenues increase with a credit. So if I want to know what increases that account, it will be a credit. So really what they're doing here is they're trying to drive in this idea that the normal balance is what causes the account to increase. it's a little bit repetitive, because if you glance down through here, credit, credit, debit, debit, credit, 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 debit, debit, it's always going to be the same, because that is exactly what a normal balance is. So however you care to do this question is fine. You might find it quicker to just do one column and then go back and jot them all in to match, because that's really what's happening here. But however you care to do it is fine. I wish they had asked you for the financial statement, but I believe they do that on the next question or later in the assignment. So that will work just fine. The next one that we need to deal with is equipment. Well, equipment is an asset. We said when an asset is increasing, you will debit the asset, which means that to increase that, you will debit the account. So we'll just jot really quickly. Let's see here, I think. Should be a way. Sorry, I'm a little bit new to this app. I'm trying to figure out if I could do a box down here for you to make this a little bit clearer, but I'll just try to squeeze it in right here. So we'll just redraw these real quick. And so, of course, what we're showing here is with the up arrows, that is the side that is the normal balance and is showing an increase to that account if you do whatever is on that side. So the left side, once again, is the debit side. The right side is the credit side. So an asset will increase with a debit, decrease with a credit. And liabilities and equity both increase with credits and decrease with debits. So the next one we want to look at here is notes payable. Notes payable is a liability. Liabilities increase with a credit. And so that is the normal balance as well. Next, we're looking at common stock, which is an equity. And equity accounts increase with a credit. Supplies is the next one. Supplies are an asset that increase with a debit. Accounts payable is a liability. And because it is a liability, it will increase as well with a credit. Next, we look at consulting revenue, salaries, expense, all of these all the way down. But hopefully now that we've looked at these first couple and using this chart down here at the bottom and the knowledge that you have now gained, you should be able to kind of work through the rest of these and figure them out on your own without too much trouble. Once again, if you do have problems, please do contact me. Next, to number 5, we're looking here at a bunch of transactions. We will work through all of these because we are so new to journal entries. But once again, I'm not going to go through all of the T account information here because it really is just a matter of moving the answers from one question through to here, which is something you'll just have to be careful when you do to make sure you don't make a mistake. But getting the journal entries right is the crucial part of all of this. So here in number 1, it tells us that the owner invested $12,500 in cash in the company in exchange for common stock. So what happened? Cash has increased. Cash is an asset. If an asset increases, you debit that asset. But what also happened is equity in the company has increased. So when equity increases, you do that with a credit. And in this case, that credit goes directly to common stock because that's what the owner got. So the first journal entry is done, a debit to cash for $12,500 and a credit to common stock for $12,500. Once again, your total debits and your total credits must always equal. And if you look in each case, that does work. So if you ever get one wrong, make sure you don't have a typo where you've left off a 0 or you've done something silly like that, and it'll help you make sure you get as many points as you should be able to get. Next, you see that the company purchased office supplies for $363 in cash. Because they purchased office supplies, which is an asset, is increasing. So office supplies is receiving the debit. But another asset is declining, and that asset is cash. So cash is being credited. So office supplies increasing, cash decreasing. Both are assets. Is the accounting equation in balance? Well, let's just check. Assets equals liabilities plus equity. You had one asset go up by 363. Had one asset come down by 363. No change. There was no change to liabilities and no change to equity. Accounting equation still in balance. So that is what you need to be doing if you're wanting to really see how this is working to make sure you're getting the most out of these homework assignments so that when you get to the exam, the exam will just be a breeze for you. Right? We want you to feel very confident as you work through these homeworks and through the exams. Next, you see that the company purchased $6,900 of office equipment, but notice on credit. Because it's on credit, we actually don't have any effect to cash. So office equipment is an asset and it is going up with a debit. Accounts payable is also going up because it is a liability, and liabilities increase with a credit. So a credit to accounts payable, a debit to office equipment. And that question is done. The next one here tells us that the company received $4,175 cash as fees for services provided to the customer. So you can get away in class calling this some type of revenue, either service revenue or whatever you want to call it. On the homework assignment, I believe you have to use the account fees earned, so just make sure you are aware of that. But the idea is the same. So we received cash. Cash is an asset. Assets increase with a debit. And we earned revenue. So the fact that we have earned revenue means that that is an equity account, and equity is increased with a credit. The next thing that we've got here is that the company paid $6,900 cash to settle the payable for the equipment purchased in C. So we are now removing that liability. So accounts payable is a liability, but it now needs to go down to zero. So if we were to look at the accounts payable T account, what we would see is that it began with a credit for $69.13. But on this date, we cleared that out with a debit for $69.13, thereby eliminating any balance in the accounts payable T account. So that accounts payable balance is going down, and the asset cash is also going down. So you say, well, how does that work in the accounting equation? Well, assets equals liabilities plus equity. Liabilities plus equity. So an asset went down and the liability went down, both by $6,900. So the accounting equation remains in balance. Okay. Now, the next one that we've got tells us that we are looking at letter F. The company billed a customer $2,650 as fees for services provided. We billed them. Have they paid? No. So did we receive cash yet? No, we have not yet received cash. Because we've not received cash, the debit cannot go to cash. Only use the cash account if you actually see cash. In this case, there isn't any. So what we've then got to do is figure out, what did we get? If we didn't get cash, we got the next best thing, which is accounts receivable. Accounts receivable is an asset. It is increasing. So it is receiving a debit for $2,650. And fees earned is still an equity account, which will be increasing with a credit. So a debit to cash, a credit to fees earned. Next, in number 7, or letter G, we see that the company paid $525 in cash for monthly rent. So because we paid it for that month's rent, and the month is presumably over, then what we see is that that will be an expense. So we will debit rent expense. So a debit to rent expense, which is an expense account, and it is increasing, which is making equity decrease. And you see cash going down. Cash is an asset, and it is in fact declining. So a debit to rent expense and a credit to cash. Next, we see the company collected $1,100 cash as partial payment for the account receivable in F. So we received a little over $1,100. So what did we get? Well, we got cash. That cash is an asset that is increasing. And at the same time, we've got an asset that is decreasing, and that is my accounts receivable. So if I were to look at my T account for accounts receivable, what I would see is that we began with $2,650. We then reduced it by $1,113 and finished with the difference, which I believe is $1,537 as a remaining receivable. So that wraps up that. And that tells me at some point I should receive that remaining $1,500 from my customer. And so we know that that should be expected in the future. Now, the last thing that we see here is that the company paid $1,000 in cash as a dividend to the sole owner. Now, what they do here is technically not correct. This is technically only right early in the semester. Later in the semester, we'll deal with dividends in depth, and we'll talk about the full procedure for how we handle dividends and all the dates associated with a dividend transaction. At this time, this journal entry does work. And it would work later, it's just not how GAAP says to do it. So do be careful. Know this will change later in the semester, but for now, and if I asked you to record dividends on the first exam, this is how you should do it. Okay? So what we see here is a debit to dividends, and we know this is going to reduce equity. And to reduce equity, we need a debit, and we know cash is an asset, and it is going down because it is being paid out, and that explains the credit to cash. Now, the next item is, of course, all the T accounts. You'll handle those the same way that we did on the previous question that had them. Now, in this question, it's really just more journal entries involving cash. I'm not necessarily going to go through all of them because we've been through quite a few. If you do struggle with them, please do let me know once again. Never hesitate to ask, especially in these early chapters, because it is so crucial for you to get a good foundation in the first 3 chapters to make the rest of the course make so much more sense for you and to boost that confidence that you're going to have when you blow the first exam completely out of the water because you're well prepared. So we want to make sure you have every opportunity to do that. Okay, so I'm not going to go through this one. It's going to be handled very similarly to how the others have been done, so do just know that. Okay. Now in this question, they're asking us to do something a little bit different, and they're saying prepare journal entries, which was number 1, which we skipped for now. If you're doing the homework, do make sure you do not skip it, all right? You've still got to do it to earn the points, but just for the sake of brevity in this video, I want to skip that so we can get to the other stuff that we've not yet done so many times. So now point number 2, it says, list below are 4 reasons why a transaction will not yield a revenue. Match each of the reasons to the transaction it properly describes. So there are 4 items. There are 5 answer choices, so you can tell right away all of them are not going to be used, so you're going to have to be a little bit careful, but we'll just work through them and see what we can figure out. So, and the first one tells us this transaction changed the form of an asset from a receivable to cash. Total assets were not increased. Revenue was recognized when services were originally provided. So if you look up here and you read through these options, the one that's going to most clearly sound like that is letter D. And that tells us that the company received $2,900 in cash from a client in partial payment of accounts receivable. So we're simply debiting the cash, crediting the accounts receivable. So you're changing the form of the asset, but total assets has not changed, and you're not recognizing a revenue because that would have been done at the original date. Now the next one says the transaction brought in cash and increased assets, but also increased a liability by the same amount. So if you read through these, you'll see that that is letter E. So in this case, you're going to see a debit to cash and a credit to notes payable. So that handles number 2. Third one, transaction brought in cash, but as an owner investment. That's going to be letter A, where we're exchanging cash for common stock. And finally, this transaction brought in cash, but created a liability to provide services to the client in the next year. So if you look through these, that's going to be letter C, where the company received cash in advance for services to be provided in the future. This is where we're dealing with that unearned revenue. And so that's what we're seeing here in number 6. Number 7, we're once again looking at preparation of financial statements in questions 7 through 9. So we'll hit this kind of like we did in the last homework assignment. And I think the best way to do this is to just start by identifying what types of accounts you've got. And once you know that, you can then tell which financial statement they will go on. So cash, well, cash is an asset. Accounts receivable is an asset. Office supplies is an asset. Land, office equipment. All of those are assets. which means all of those will go on the balance sheet. Accounts payable is a liability, and common stock is an equity account. Next, we see dividends. I'm just going to write RE because I'm telling myself that's going on the statement of retained earnings. Consulting fees earned, that's going to be an income statement item because it is a revenue account. And then all of these are expenses, which is also the income statement. So this is a revenue on the income statement. Okay. Now all of this is going to go on the balance sheet, and more or less all of this on the right side goes to the income statement, with the one exception being those dividends. They will not go to the income statement, but all of this goes there. So when we come down, we'll see consulting fees earned, $27,130. Boom, right there that goes. That's our only revenue, so that gives me my total revenue. Once again, don't be concerned if there are extra lines. All lines do not have to be used to mean you got the answer correct. Oftentimes they will give you an extra line, or even 3 or 4 lines sometimes, just to see if you really know what you're doing or if you're just plugging stuff in to fill in all the blanks. So make sure you don't fall for that trick. The next thing you want to do is come in and see about your expenses. In this case, it's everything starting at rent expense and coming down. So you take your $96.90, $57.10, $10.10, and $6.20. All of those are going to drop in here, which will give you your total expenses of $17,000. You will then take your 27 minus your 17, which will tell you have net income of just over $10,000 based on the information that we have been provided. Now the next question, we're dealing with the statement of retained earnings. As always, for the statement of retained earnings, you need to start with beginning retained earnings, which in this case was 0, and they tell us that here. The retained earnings account balance at August 1 was 0. Hint, and they even tell you here, net income for August is this. So that should let you go back and check to see if you did this right. If you did, those numbers should match. If you did not, then they'll be different, and you'll know you have a mistake up here. Now, the next thing you'll do is add in your net income. That will give you the starting point. Then you will back out any dividends that were paid, which was just over $6,000, which gives you your ending retained earnings balance. Now this ending balance will then flow from here on down to your balance sheet. So if you just see how this flows, what you will notice is that $39.70 drops right there. So this is how we know that this is the order our financial statements must be prepared in, because if I tried to prepare my balance sheet before my statement of retained earnings, I would be using 0 instead of $39.70, and my balance sheet would not balance. So now we need to just flip back up to that top piece, so I'll do that real quick. We'll take a snippet of it, pull this down so that we have access while we are looking at this. And you can see, maybe, and okay, well that's not going to work for some reason, so just believe me that this is where these numbers are coming from. If you need to, you can flip back up, rewind the video, take a picture, do whatever you need to do. But that will tell you that your cash is $25,460, AR is $22,510, office supplies $53.80, equipment and land, which gives you total assets of $117. Next, you'll see your accounts payable of $10,370. Once again, is your only liability. So you will now, normally you would see a total liability line, but because there's only one liability, they have omitted that. That is fine. But just know if you did have more than one, you would see a total liability line in that position. Next, you have your common stock of $103,300, which once again is just given to us right there. And then that $103,300 will be added together with your ending retained earnings balance of $39.70, giving you total equity of $102,270. Then when you take that, $107,270, you'll take that, add it to your $10,000 for accounts payable, which will once again end in the equality between your assets and your liabilities and equity, proving that your balance sheet is balanced and giving you that confidence that you did do this properly. Now, number 10, all we're going to do here is prepare what is called a trial balance. Now, to prepare a trial balance, all we're doing is making sure total debits equal total credits. So what you're going to have to do is figure out, is each one of these accounts an asset, liability, equity, whatever, and does that carry a normal debit or credit balance? When you get down to the bottom, hopefully this thing should balance if you have done everything properly. So, cash, instead of putting the type of account, I'm just going to put the normal balance next to it as either a C or a D, just to help us down below a little bit, but I'll talk through the whole process. So here you've got cash. Cash is an asset. Assets go up with a debit. Office supplies are an asset. They increase with a debit. Prepaid insurance is also an asset, also a debit. Office equipment, also a debit. Accounts payable is a credit. Common stock is a credit. Dividends are a debit. Engineering fees earned are a revenue, which is a credit. And rent expense, which is an expense, is a debit. So now when you come down, you'll see cash on the debit side. So we'll just go down $50,864. Office supplies $1180. Prepaid insurance $46. Office equipment $15,000. The next debit that we see is dividends $37.56, and rent expense $72.80. Now for the credit side, we'll use yellow, and we'll see that we have $15,000 in accounts payable, $23.5 in common stock, and $44,000 in engineering fees earned. When you add up all of your debits and you add up all of your credits, what you will once again see is the sacred equality between total debits and total credits, where we see that no matter what, when you've done your work properly and everything works, your total debits will always equal your total credits, and your total assets will always equal liabilities and equity, which is what we prove with the balance sheet. So hopefully working through this homework assignment and working through this lecture has helped you understand how this all works, how this is all going to come together both in this chapter and in future chapters in this course, so that the stuff that we cover will make the most sense to you and you'll be able to be successful. Please, once again, never hesitate to ask for help. I'm always happy to do that. So please let me know if you have any questions. Hope you have a great day. Thank you.